To prepare for a stock market crash, what is going on, YouTube family? That is what we're going to be talking about in this video here today. So obviously you don't have to be a genius. There has been some pessimism rising in the market. You can see what's going on. You can see the Dow dropping. You can see the NASDAQ dropping, which is expected. You would expect the NASDAQ to drop first because a lot of those tech stocks have run a lot. But here in this video, I thought it would be important to how I prepare, or some things I do and some things I try to remind myself of when a stock market crash is current. If we're in a stock market crash and things just, keep going down, it seems there's just more and more blood in the streets, or if I think one might be on the horizon and one's really not too far off. So I really hope you guys get some value out of this. And these are actually good for a lot of different reasons. First off, because when stocks go down in the short term, it presents a lot of great buying opportunities and allows you to make more money over the long term. Second, it allows us not to get any sort of bubble territory. Think of it this way, right? So when you go running, right? Say you want to run 20 miles, or you run 20 miles a day. At some point, whether it's mile 19, mile 20, or if you keep going, mile 25, whatever the case may be, at some point you're going to get tired and you're going to burn out. Well, the stock market's the same exact way. If stocks keep going up and up and up and up and up, one day it's going to crash and it's going to be ugly, all right? Same way as if you're running. If you just keep running and running and running, eventually you're just going to collapse because, fatigue, dehydration, one or the other, it's just not going to work out for you. So this is what I'm trying to do. I'm going to try to bring into perspective that this is a good thing and that no one does anything they're going to regret over the long term. So hopefully you guys get some value out of it. If you do, please drop a like on the video. That would really help out the channel massively. Push this video out to a whole new audience and hopefully help some newer investor out there that maybe might be thinking about selling or panic selling, whatever the case may be. Also, remember to subscribe to the channel if you want to see more videos like this related to personal finance, stock news, stock analysis, everything in between. So the number one way to prepare and be ready for a stock market crash, the holy grail, is to have cash around. Now, this doesn't mean save every single dollar, every single dime by any means. I don't think you should ever just be hoarding every single dollar, every single penny into your savings account at all. Because you don't want to have too much cash. Like, you don't want to be like 90% cash, because then that is a cash problem. So obviously if there is a market crash and you are, say, 90% cash, obviously you're in great shape because you have so much cash to deploy whenever you would like. But at the same time, no one knows exactly what the market's going to do and when it's going to do it. I think March of 2020 is a great indicator of that. I think everyone and their mother thought that the market was going to decline again at some point after that run we saw, and I guess we're still somewhat in the midst of, right? And if you're someone out there that's telling me that you thought the stock market was going to do that, you're a liar. I don't believe you. That's it, period. I do not believe you. Anyway, so if you have too much cash, and the market does not go down, then you're in trouble, because then your money's going to get devalued, and then you get in a situation where it's like, all right, maybe these companies are overvalued, but I have too much cash, I have to deploy it, what do I do? That's when it gets difficult, and that's when it becomes a problem.
Hey fellas, look what I found in my pocket. Look, a year's salary right here. What I call them? Fun coupons.
So what I like to do and what I preach, and I didn't come up with this at all, but this is what I do and this is what worked well for me. I try to go 10 to 30% cash. 10% cash if, like, say it's a situation like that's March, where everything's literally on sale and you can throw a dart anywhere and it's going to be a bullseye. Essentially, that's what I like to look at it as. 30% as if everyone's being greedy and we're in like a really ridiculous bull market, like kind of like we've been in, where it's like there's not a ton of deals and I just try to pick a few stocks, pick a few things that are very undervalued. That's when I get more 30% cash. So if we do see some sort of correction or maybe a crash, if we do get that, then I'm ready and I still have cash ready to deploy. So for example, to put this really in simple terms, if that still doesn't make a ton of sense to you guys, say you have $10,000 to your net, that's your net worth, $10,000. So that means between whatever situation we're in, if we're in like a situation like March where the market's completely undervalued and there's something short term that has most investors scared, then you would have $1,000 in cash. On the flip side, say we're in a situation like we've been in and maybe there's not as many deals out there in the market and we're at all-time highs, that's when I would go $3,000 in cash, or 30%. But the reason why it's so important to have cash around is because it puts you in position of power, because it's no fun watching that market go down, watching all these stocks go down when you don't have money to buy stocks. There's only three categories of people that I look at as that really do not want the market to go down so they can get discounts on stocks. Those are people who are retired and maybe they're living off of their retirement savings and their investments. Makes sense. Those people that are all in, makes sense, because it's not fun to be all in and not be able to sleep at night because you're so stressed about the stock market going down. That's also not fun. And those people that did not do the full research and that didn't understand their strategies, don't understand what they're invested in, and they're just kind of gambling their money around. Those are the three categories I came up with. So basically, it's always good to make sure you have some cash around. Like I just said, I didn't come up with this strategy, but between 10 and 30% is what I've learned, and that's what I like to preach. So do what you need to raise cash. Maybe it's trimming a position. Maybe it's selling off a position of your least favorite stock. Maybe it's pulling a little bit out of each stock that you own. Whatever the case may be, try to raise some cash so if the market does go down, you're in a position of power. If you don't have cash, you're not in a position of power. And believe me, from everything I've seen, from everything I know, it's not fun seeing that market go down, seeing that market decline, seeing all these deals open up and you don't have any cash to take advantage of. The second thing that you need to prepare for, and this might be more of a psychological thing, I don't know if there's any way to really prepare for it. It's kind of like buying a house, moving out of your parents' house. It's just not a way to really prepare for it until it happens. But do your best to psychologically prepare to not panic sell. Now, stock market corrections and crashes, those are things you do not want to fear, okay? There's things you want to embrace because when stocks go down in the short term, that means more money over the long term. Like it literally does not matter what happens to that stock price today, tomorrow, next week. Where's that stock price going to be in 5 years? That's what really, really matters. So I have this example here. Say you buy 100 shares of company X at $100, right? That company ends up going down to $80. Why not buy more? Assuming you did your full research, your full due diligence, you looked into the company, you looked into the CEO, you did all this research, and you believe at $100 that company is undervalued, and over the long term it's gonna go to maybe $200 a share or $300 a share, why not buy more at $80? Seriously, why not buy more? Now, using this example, and I've used this example a couple of times on the channel, say you go to buy a new iPhone. Your iPhone broke, whatever the case is, it fell in water, you need a new phone and you want to get a new iPhone. So you want to go get the iPhone 12 for $1,000, let's say. You get to Best Buy, you get to Verizon, wherever you're going to buy it. You see that that iPhone that you want is on sale for $800. Are you going to say, oh, well, that iPhone is $200 cheaper than I thought it was, so I'm not going to buy it? No, you are not going to say that. You're going to be super excited because you're saving $200. Well, the same thing applies here. It's literally the same psychology in theory. You're saving $20 in this example by buying this at $80 as opposed to $100. Now, obviously, this is easier said than done, especially if this is your first stock market crash or stock market correction. It could be a lot to see your portfolio go down, down, down. You might get really stressed out, especially if you're all in, which is going back to the first point. Don't do that. Always have some cash around, okay? But keep in mind, you're gonna regret it if you panic sell. Believe me, I've done it, and it's not a good feeling when you panic sell like that. And I've learned the hard way because I've left probably well over 6 figures on the table by panic selling. Trust me, guys, it's not a good feeling when you panic sell and your bullish thesis plays out and you're not in that stock. Trust me, I know it's not a good feeling. Just keep telling yourself, when stocks go down in the short term, I'm going to make more money in the long term. Because you might feel good when you sell out and you panic sell. You might be like, all right, I can sleep again. I don't have to worry about it. But when the economy recovers, when the stock market recovers, and you see those stocks go up that you owned, and you're on the sideline because you sold out for, I guess, short-term satisfaction, you could say, because you didn't understand your strategy, because you didn't do the full research of the company, it's not going to be a good feeling. And it's going to feel worse than you felt when your portfolio was going down. Trust me, you're going to feel much worse.
Is money going up, but we only going up.
The third thing that you should do to prepare for a stock market crash, and you should be doing this every so often anyway, whether you're preparing for a crash, you think a crash is coming, whether a correction is coming, or whatever, is review your portfolio and make sure you don't have too many spec stocks. So basically what a spec stock is, if you're a new investor, is a stock that really has a lot of upside, but it also comes with a lot of risk. Maybe that company is very early on, they haven't really had a ton of development, they haven't shown a ton of products yet, but they have a lot of upside. So you put a very small percentage, maybe like 1 to 2% in there, and see what happens. And basically you just put it in the filing cabinet and you're like, you know what, whatever happens, happens. If it goes up 300%, perfect. If I lose all my money and the company goes under, all right. You know, it is what it is. So a good example of a time when this happened was the tech bubble. A lot of these stocks in the tech bubble had insane evaluations. They really hadn't proven anything, and they were all just overvalued and none of it makes sense. They didn't have a ton of moat. It was really, really weird, and they just had these valuations for no reason at all. So if you're someone that wants to invest in spec plays, I personally don't invest in spec plays just yet because I really just enjoy, you know, finding stocks that are undervalued. But if you want to invest in spec plays and you have maybe 1 or 2 stocks making up like 3% of your portfolio, okay, that's fine. You know, you lose that money. So say you have $10,000, use that example again, and maybe, you know, what is that? What does that come out to? 1%, 2% of $10,000. If you really lose that, is that going to make or break your portfolio? No, it's not going to do it. If you lose that $100, $200, $500, no, it's not going to make a big deal. But if you have, say, 10 stack plays, that's an issue. So when you're going through your portfolio and you're preparing for a stock market correction or a stock market crash, ask yourself questions like this. Is that company profitable that you're looking at in your portfolio? And do they have good cash reserves? Next, if they're not profitable, can that company become profitable within the next 12 to 18 months per se? Basically, is there like a probability that they have short-term profitability on the horizon? And lastly, are they telling you a story or are they showing you a vision? And basically what I mean by that is, has that company proven they have products, that they're innovating, that they have a vision and they can keep going forward? Or are they just blowing smoke and telling you a story like, oh, we're gonna do this in a couple of years, we're gonna do this in a couple of years? You need to have the proof in the pudding when you're investing in a company if you wanna be confident. That's the bottom line. So the fourth tip for a stock market crash, stock market correction, whichever one, is be ready to buy, but never go all in. So I feel like every time I've seen maybe a correction in the market or a crash in the market, even though I really haven't seen too many crashes in my experience in the market, mainly it was just March, but I've seen a few corrections, and I feel like every time, or really anyone who wants to get involved with the market, they're always like, I'll buy when it comes back down, or I'll buy when it goes lower, I'll buy when it gets lower. And the problem with this is, where is the bottom? When are you going to get in? That is the problem. You can always say, I'll buy next week, I'll buy, next month, I just need it to go a little lower. But the thing is, if you keep saying that, you're never going to get involved in the market and you're never going to end up buying anything. That's the bottom line, and that's the hard truth. Because I was like that for a while. Even before I started investing in index funds, I'd be like, oh, VU's at 250, I'll wait till it comes down to 200, or something like that, whatever the numbers were at the time, I don't remember. And the problem is, it took me longer to get involved by doing that, and I lost more money. I would have made so much more money if I had just started investing. And that's the point I'm trying to make here. In general, I mean, this is obviously not a stock market crash. This is more of like a general perspective, but you just need to start. Like, if you want to change your financial future, you honestly just need to start. Doesn't matter if the market's at all-time highs, all-time lows. I mean, don't get me wrong. If I had to pick, I'd rather have the market be at all-time lows when I was starting. But the point is, you don't know what the market's going to do. You have to get involved if you want to change your financial future and be successful. Anyway, we kind of got a little bit off topic there, but no one's going to know when the bottom is. That's the thing, especially in a correction or a crash, because everyone on CNBC is going to say the market's going to zero. Like, the market's never, ever, ever coming back. Everyone on CNN is going to say the market's going to zero. It's never coming back, ever. There's going to be so many bearish people when this is happening. It's like the thought of the market ever returning to all-time highs is completely ridiculous. So if you don't get involved and you just keep waiting for that bottom, you're honestly going to miss the bottom, and the market's just going to end up going back up. So you want to nibble. Don't go all in. Nibble. Take a disciplined approach, because if you take this disciplined approach, you're never going to run out of money and you're never going to be at the mercy of the market, because that's what happens. If you go all in, you're at the mercy of the market. This is when you get to the point when you're checking your stock market portfolio 10 times a day to see how much money you lost, how much money you made, whatever the case may be. And it's not a good 10 times checking it. If you're checking your portfolio, say 10 times, and you're looking for good buying opportunities, you're looking to deploy more money into the market, that's not bad. I don't view that as bad. I view that as a good obsessive, because you want to put more money in to make more money. Like this time, I'm checking my portfolio a lot. Do I care what my portfolio is at? Not really. I just want to see what the prices of those stocks are at so I can buy more. That's the bottom line. But if you don't have any money to deploy and you are all in and you're still checking your portfolio 10 times a day, that's not good, because you're at the mercy of the market. That's when you start losing sleep at night, and that's when you start to panic sell, and that's when you start getting worried. So say a disciplined approach you could use. I mean, obviously you have to decide what approach you want to take and what disciplined approach you want to take, or even, I guess, if you want to use a disciplined approach. But something you could do is say, all right, every 3%, 4%, 5% down movement, I'll throw $500 into this stock. Me personally, the lower it goes, the heavier I buy. So maybe, for example, say, all right, this stock moved down 3% today. Let me put $500 in. Now, next week, all right, this stock moved down another 5%, so that's 8% down total. All right, let me put $1,000 in. Just for example, usually as it goes lower, I will buy heavier and heavier and heavier. That's just what I do. That's my approach. Obviously, just figure out what approach works for you, what approach you feel comfortable with, however much capital you have to deploy in the market. And as long as you've used a disciplined approach, it honestly should work out well to you, and you'll always have money to deploy, and you'll always be ready for any opportunity you see. But going all in, that is not good. Do not go all in, but be ready to buy. Don't be afraid to buy. Be confident when you're buying. Just don't go all in because that's not a good feeling. It's not. And the last way that you can prepare for a stock market crash is to review companies you've looked into, but you do not own. Now, some of you might find this a little interesting. Some of you might be confused by this, but this is gonna make a lot of sense here in a second. So sometimes you're gonna look into a company. You're gonna do your entire research. You're gonna read the 10K, the 10Q, look into the management team, the conference call, everything. You're gonna love the business model, like it's a fantastic business model. You love the industry, but at the end of the day, the company's just overvalued and you just simply can't buy it because you believe it's overvalued. It's gonna happen. It happens to me, more times than not, especially within the market we're in. I'll, do all my research. I'll do everything. I'll love the business model. I love where the company's going, but I just don't want to pay that price for the stock. I don't like where the market cap's at, and it's just simply too overvalued in my opinion. So what I do, I stick that in the back of my head, and I stay up to date with the company. I'll see what the company does for quarterly numbers. Maybe I'll read the annual report when it comes out. Maybe I'll listen to the conference call. Just basic things that don't take too long that you can do very easily and stay up to date with, just to make sure, the company's firing on all cylinders, everything's going according to plan, the company's executing, the management team didn't have anyone step down, the CEO's still there, all those things. Just stay up to date with the company. A couple of companies I'm doing this with right now are Toll Brothers and DraftKings. I love Toll Brothers. I love the management team. I love the numbers they're putting out. I just feel like the company's overvalued at the end of the day. DraftKings, the same thing. I just feel like the company's a little bit overvalued. I love the industry of DraftKings. I feel like sports betting's not going down at all. I feel like it's just going to continue to rise. I just feel like it's overvalued. So what this does, when you stay up to date with these companies, when you get to the point where you're at a correction or a crash or anything along those lines, and you're familiar with these companies, and these companies drop, and nothing's changed with the fundamental business, there's your buying opportunity. You have very little work to put in before you can buy these companies because you're ready. You've already had the full research done. You're still up to date with these companies. You can buy almost immediately. Obviously, if you're just keeping up with the quarterly numbers and listening to the conference call, you might need to do a little bit more work and dive a little bit deeper before you dive in or before you buy in. But if you're starting from scratch, that's gonna take a lot longer to feel comfortable and confident buying these companies than if you've done the research and you've stayed up to date with it. That's why I'll look into a company and a lot of times I'm just like, it's overvalued. Do I wanna continue researching it? I mean, yes, because I genuinely like doing this stuff, but sometimes I'm like, I wish I could just find an undervalued company that I could buy. But over the long term, this could absolutely pay dividends. It could absolutely pay dividends. So if you guys have any companies out there right now that you've looked into, or maybe you've looked into in the past, and you really like the business model, but you just didn't want to pay that price for the stock, go back and look into them now. Re-look into them. Listen to the conference call. Keep up to date with them going forward. So refamiliarize with yourself with them and then stay up to date with them as time goes on because you never know when you're going to find an opportunity to be in that stock. It could be a beaten down stock for no reason. It could be a growth stock. It could be a very undervalued stock. And if you can get good at all of these things, you can get good at staying up to date with them and identifying these good buying opportunities, that's when you're gonna be a successful investor. That's when you're gonna have success in the stock market, and that's when you can really start to increase your wealth. And this is just gonna continue to spread to several other aspects of your life, guys. I can promise you that much. Anyway, guys, I'm saying that's gonna be it for this video. Thank you so much for watching. I really appreciate it. If you did get some value out of this, please drop a like on the video. That would really help out the channel, help the channel grow in a massive way. Also, if you want to subscribe to the channel, go ahead and do that. I would really love to get this channel to 500 subscribers very soon. We're up there. We're getting up there slowly but surely. We are getting up there, so I'm very excited for that. Let me know down in the comments what you think of this video or what you think of stock market crashes. If you think I missed anything that could help you prepare for stock market crashes, if you think we're going to have a crash, if you think we're in bubble territory, how far you think the Dow's going to go. I'd love to hear from you guys in the comments and love to hear your thoughts about what you guys think. And I'll see you guys in the next video.